Hello, and welcome to this first session of FMP of the Financial Risk Management Program curriculum. FMP can be a daunting area, as is the case with the entire FRM curriculum. So we start off with the first chapter of Financial Market and Products, that is bank. So without much ado, let's now move to banks. All right. Okay. What are the learning objectives? Identify the major risk faced by a bank and explain the ways in which these risks may arise. Distinguish between economic capital and something called as the regulatory capital. Summarize the Basel Committee. What is a Basel Committee? We will come to know a little later. The regulations for a Basel Committee and the requirement of the regulatory capital. Explain how deposit insurance may give rise to something called as moral hazard. So we will need to understand what is the deposit insurance in the first place, and then we will understand that how may it give rise to a problem of moral hazard within the domain of banking. Describe investment banking financing arrangements, including private placement, public offering, best efforts, firm commitment, and Dutch auction approaches. Describe the potential conflicts of interest among commercial banks, securities services, and investment banking divisions of a bank. In this particular context, we are going to refer them as BHC, or the bank holding companies, and recommend solutions to the conflict of interest problems. Describe the distinctions between the banking book and the trading book of a bank. And last but not the least is to explain something called as originate to distribute model of a bank and discuss its benefits and drawbacks. So without much ado, let's first start with the bank itself. So as you may be knowing that banks are the backbone of any economy. Why? Because it provides the credit market. However, banks can be subdivided into two parts. One is a commercial bank, another is an investment bank. The banks that we are most familiarized with are the commercial banks. Investment bank, on the other hand, is more of a misnomer, because the way we understand traditional bankings, investment banks will exactly not do any of those things. So for example, if you were to go to an investment bank with the quest of opening up a savings account or a checking account, or perhaps raise the requisition for a commercial loan, or even a business loan, or even a personal loan, a mortgage maybe, well, those things normally are not done by the investment banks as far as retail customers are concerned. On the other hand, the traditional banks that we understand that deal with us regarding the deposits, regarding the mortgages, the auto loan, student loan, etc., they are subject to various regulations. Their activities could be subdivided into wholesale banking as the retail banking. The wholesale banking, in a nutshell, has got to do with the corporate sector as such. So that is to say that the aspect or the arm of the commercial bank that deals with the corporate sector as a whole can be grouped under the wholesale banking. On the other hand, retail bankings are normally the commoners, for the commoners, people like you and me who would have certain banking needs. The division of the bank that deals with it is known as retail banking. A few point of differences that we need to understand is, how does a bank operate? So if you think of bank as a depository participant, what it does is that it takes actually deposits from its customers, and in the form of savings perhaps, and then disburse to eligible borrowers. Now, the borrowers, as we have understood, could be a large corporate or it could be a retail customer. Now, if you come to think of it, the cost of acquisition as far as businesses are concerned from the bank's perspective, the wholesale banking customers' cost of acquisition is predominantly lower than that of the retail one. Why is it so? Because it is mostly a relationship-based banking that we are talking about. Once the relationship is established, thereafter it piggybacks and new doors open up. So as such, if you look at the whole gamut of experience as from the corporate's perspective, or let's say the SME, small and medium enterprises perspective or business perspective, their banking, the cost of acquisition of business as far as the bank is concerned is pretty low as compared to retail bank. But at the same time, we also must understand that the spread, that is the difference between how the bank raises the capital and disburses it, which is basically the interest. So this raise the capital, that this is where the bank will have to pay the interest to its depositor, and when it disburses loan, it receives interest. The difference between the two is called something called as the spread, and the spread is what the bank's interest margin is all about. The spread is also what the bank's earning is all about. As far as the wholesale or the corporate banking is concerned, that spread is considerably lower as compared to a retail bank. On the other hand, investment banks are not quite subject to regulations. Why? Because they are, in the true sense, not banks as we understand banks. Secondly, they don't deal with public money, or at least they are not supposed to deal with public money. They do not come into interface with opening up of a savings account or issuing a checkbook or issuing a credit card, things like that. Hence, rules of regulations per se do not apply. That is not to say that the investment banks are fully left ungoverned. There are cases that we understand. There are spheres of business that we will understand where the investment banks are also investment banks are also subject to regulation. So let's talk out the major activities between these two sorts of banks. As we have already discussed, a commercial bank is the one that is empowered to lend, refinance, and make advances. It also has certain fees-based income. For example, it may open a letter of credit on behalf of a customer in a foreign land. It can also facilitate forex transactions. So these are certain fees-based income, which is other than the interest rate margin that the bank actually derives its revenue from. Before the 1930s, in the US, there were, really speaking, no such a delineation between the commercial bank and the investment bank. That is to say, under one roof, a bank could execute the activities of a normal day-to-day commercial bank. And on the other hand, it could also execute and partake into the activities of an investment bank. Now, let's understand what an investment bank actually does. An investment bank, as I said before, does anything but the banking activities as we understand the traditional banking activities to be. However, the investment banks can be further subdivided into two sides. One is called the buy-side firm, and another is called the sell-side advisory. So the major difference between these two sorts of investment banks are that a buy-side firm can actually invest its own money. Whereas the sell-side advisory investment banks are predominantly engaged into extending their services. Those services can range from public and private placements, for example, an IPO, advisory services, for example, advising a client for their impending joint venture, mergers and acquisitions, making a roadshow for an IPO maybe, or creating a roadshow for raising funds on behalf of customers, capital restructuring, uh, management consulting. So these are the activities that the investment banks do execute. Brokerage is one more aspect. IPO, that is initial public offering. FPO is follow-on public offering. NFO is a new fund offer. All of these activities are grouped under something called as the merchant banking services. Now, these are predominantly the sell-side advisory wing of an investment bank. The sell-side advisor or the investment banks of these nature, they also do something called as research. Research on what? Perhaps an equity, perhaps about some bonds, perhaps about a particular market, whether that market is lucrative enough to enter or not. Now, a syndicate approach would be that they would actually publish these reports against a fee. So that is to say that a sell-side advisory investment bank, they may write research reports about equity, bonds, different financial products, maybe some strategies as well, may actually talk about a certain market, etc., etc. Now, these research reports, they might sell to interested public. Interested public would mean that they might actually sell this to another investment bank. That could be the case. Whereas when we talk about the buy-side firm, the buy-side firms are those firms who may actually consume the reports published by the sell-side advisory, or the buy-side firm could also be the one which already has its in-house research department. Now, those research papers are going to be fully consumed by the firm itself. So that is to say that the buy-side firm, buy-side investment bank, they do not publish their researchers to the outside world. Now, as far as our curriculum is concerned, per se, there is no direct mention of the sell-side advisor vis-a-vis the buy-side firm. But since we are going to learn about investment bank in parallel to the commercial bank, hence certain activities that are predominantly characterized by the buy side, as well as those activities that are characterized by the sell side advisory, we need to have certain grasp of the same. Let's first discuss the commercial bank itself, the banks that we all know. The commercial banks face certain risks in the market. What are those risks? Market risk, credit risk, and operation risk. We could classify them in these three main sort of risks. Let's first start with the credit risk itself. And I'm sure that it's not going to be that much of a trouble to understand that a commercial bank will face credit risk. Why? For one simple reason, that it is a borrower. So anybody who borrows from the bank obviously also renders some sort of risk. What is that risk? The risk of default. What do we mean by default? Well, the probability that the borrower may actually not return the principal borrowed from the bank itself. Is that a risk? Of course, that's a risk. We also must understand that a commercial bank, every time it actually sells a new loan to its customer, it buys in this credit risk. In addition, the commercial bank, as with any other institution, also has some treasury activities of its own. Most of these treasury activities are actually limited to its proprietary trading desk. Also, the commercial bank may have certain counterparty with which it might have entered into a bilateral transaction. And the instrument that these parties may be using are complex derivatives. If that is the case, then here again, the risk of default is very much a reality. So these two are what we understand as the credit risk. Perhaps it's one of the biggest risks that a commercial bank may face. Now, what are the mitigants against this kind of risks? Well, the mitigants are basically, to start with, that banks should be careful in order to understand that whom it is actually dealing with. So, in principle, banks should not actually lend money to ineligible borrowers. That is to say that they should follow the, the, the prescribed guidelines. For example, if it's a retail customer, then bank must understand that a FICO score or of less than, let's say, maybe 660, FICO score less than 660, may actually invite the trouble of somebody actually defaulting on their loan. In India, FICO is replaced by something called as CIBIL. Here also, we understand that the borrower who has a prime credit history, or the borrowers who are good borrowers, their FICO score would be upward, or their CIBIL score would be upward of 650. A sweet spot of CIBIL score of 750 is something that every bank would want to deal with as far as their customers are concerned. So the first thing that the banks should do is to actually see that what pool of customers they are actually dealing with. In other words, they should not be extending loans to very risky customers knowingly. But of course, one cannot fully predict that what things might unfold going forward, because most of the loans that the banks actually deal with, they're long-term in nature. So in order to mitigate those risks, banks are encouraged, or technically speaking, they are actually required by the regulator to suitably charge their income statement and balance sheet on an advance basis. So that is to say that every time the bank actually loans out, let's say $100, it perhaps needs to keep $1 reserve from its equity capital towards the probability that this $100 that has been loaned out may actually default. Similarly, as we have discussed before, that the banks may have, owing to its own proprietary trading desk, or the banks may have signed some bilateral contract, mostly what we call as the OTC contract, owing to which the banks may face some sort of default risk from its counterparty. So in such cases also, even if they have not materialized, the banks are supposed to take suitable provision, or rather say suitable provisional charges, in their income statement as well as in their balance sheet. Something known as the credit value adjustment has to be done in the balance sheet immediately after the bank has entered into any sort of derivatives transaction. So this is as far as, in a nutshell, credit risk is concerned. On the other hand, the banks are also faced with market risk. Why? Because every bank is obviously impacted and affected by the macroeconomic factors. What are the macroeconomic factors? Well, inflation to start with, interest rate. What about the forex rate, the volatility of, let's say, dollar to pound or euro to Indian rupee, the volatility of the same? What about the commodity prices? The banks are, of course, also exposed to the policy risks as well, because every time there is a significant change in the monetary policy or the fiscal policy, or in general, the changes in the banking norms, that would definitely impact the bank. Not all impacts are bad. There could be good impacts as well as bad ones. But nonetheless, all of these risks are systemic in nature. That is to say that these are the risks on which the banks do not have quite full control. I'm sorry, these are mostly the systematic risk. Systemic would be a wrong word here. So nonetheless, the banks are also exposed to these factors as well, which we are going to group under the market risk. The last, but obviously the most challenging risk that a commercial bank may face, or for that matter, any organization will face, is the operational risk. It is the most difficult risk area to actually manage. Why? Because a large part of this risk is man-made. For example, if there is an internal fraud committed by an employee of the bank, and there are thousands and thousands of employees of a particular, it is very difficult to pinpoint that on any given day how one may behave. Human beings per se are obviously different element altogether as far as predictability is concerned. They're highly unpredictable. So operational risk could emanate from internal fraud, external fraud, even a workplace negligence, what we call is a common error, mistake, hardware failure, software failure, maybe a major catastrophe, any sort of business disruption. So all of these things are actually part and parcel of something called as the operational risk. In short, risks that cannot be grouped under market risk, credit risk, or something called as the liquidity risk, we typically group them under operational risk. Of course, excluding the strategic or reputational risk. Now, before we move into a little deeper, let's understand that as far as the bank is concerned, why the capital and its structure is so important. If we look at a normal company would have debt on its balance sheet. It will have an equity on its balance sheet as well. These two obviously form the part and parcel of the capital structure. Is that the same with the bank? The answer is both yes and no. Why? Well, in the traditional sense, of course, there are going to be the initial promoters of a bank, whom we are going to group under the equity. There are going to be certain debt providers of the bank as well that would have provided debt to this bank. So obviously the debt providers are also going to be there. They're obviously the creditors of the bank. But a commercial bank would also have their depositors. Who are these depositors? The depositors are people like you and me who have parked their savings account with the bank, who may have certain checking account with the bank. Some of the small customers may have current account. Some of the large customers may also have some current account. All of them are pushing in money, hard currency, money, in the form of raw material to this particular organization. And this is exactly where a financial institution like that of a bank or a banking company differs from a normal company. Because as far as a normal company is concerned, their capital structure is limited to the original promoter, the equity holder, and the creditor of the company itself. But when we think of bank has three layers of actually capital that can be actually put into use. First, of course, is the promoter's equity. Second is the creditors that may have made certain advances to the bank. And last but not the least are the depositors. Now, I want you to think through that what can happen as far as a bank is concerned. Let's say as far as a successful bank is concerned. What can happen? Yes, you have guessed it right. The bank will grow, right? If the bank grows, it is prudent to say the bank would have increased operations. So that means that they would expand as far as their branches are concerned. Since the branches are concerned, they're expanding their branches. That would account for more business. More business would mean more depositors. More depositors would mean more money. So initially, when the bank perhaps had started, the equity provider had put in $100. The debt provider would have put in $200. Altogether, the bank started its operation with $300. But over a period of time, as the bank expanded, as people's confidence actually grew in that particular bank, as the banks actually forayed into new geographies and expanded its branches, number of branches across the country, their depositors also grew. And initially, if the depositors were parking in, let's say, $500, because of this enhanced business footprints, that 500 may easily transform to $5,000. Now think of it, the bank today now has, in retrospect, the bank might have 100 here, 200 here, and 300 here, 500 here. So all put together, the bank had around $800 to do business with. That means it could lend out $800 at the max to the borrowers. But because of this enhanced footprint, because of the new depositors coming in, the bank today has got now 100 here, 200 here, 300, and $5,300 to do business with. Is that a large amount? Of course, it's a large amount. But where lies the trick? The trick that lies here is that here, $100 is still the equity capital out of a total lendable possible capital that's there at the bank's disposal of $800. And here, $100 is still the equity capital, but out of the total disposable lendable capital being $5,300, which means this is significantly less as proportion as compared to this. One might argue that what exactly am I trying to say? What am I trying to imply here? Well, the thing which I want to draw your attention to is that in both of these cases, it's the promoters of the bank that make the big decision. Which decision? The decision to lend. More precisely, where to lend and whom to lend. To the unsuspecting readers or audience of mine, one might think that, is it not always been the prerogative of the bank? Yes, it's always been. But think of it. If I were to give you $100 and you were to also put in $100, both of us put together $200 were to start a business. Our objective would be to see that not only our money is safeguarded, but we do our due diligence, we put in thorough research, do our own homework before we actually foray into a new business altogether. We'll be cautious, we'll be safeguarding our money because it's our own investment, it's our own asset. But come to think of it, that I have $100, you have $100, we both are partners. Somebody else is putting in thousands of dollars behind us, and they're asking us to take the bet. Perhaps we would be happily be taking that bet. Why? Because the depositors, they do not participate in the profit of the bank, right? They're only concerned with the interest that they earn from the bank. But as far as the equity holders are concerned of the bank, obviously they are going to reap the profits should the bank perform well. If the bank grows, they grow. If the bank performs well, their capital swells. Which drives us to the next point, that if enough time elapses through this practice, there will come a time when the equity holders or the promoters of the bank, the ones who are at the helm of decision making, will start taking risky decisions, because the incentive to earn humongous profit at a mere $100 capital is too good and too tempting to let go by. And that is where the trouble might actually brew, because if those risky loans go bad, it is not only the promoter that they're going to lose the money, but it may directly affect the depositors whose entire interest is limited to their earning of interest from the bank itself. Remember, the depositors do not participate in the bank's profit or loss. If you have understood this portion, a large part of why the capital and its structure of a bank is important should be abundantly clear. Because if this portion, if this slide is clear to you, you would now understand the need of regulation and the different aspects of regulatory measures as well. So this slide literally talks about that in a nutshell, that at the initiation, it was 100% equity. Then obviously the debt providers pitch in. Which debt providers we're talking about? We are obviously talking about the initial capital providers. They are not the depositors. These are not the depositors we're talking about. But as the bank's footprint enhances, increases, as the bank actually gets on with more business, the depositors add into them bank, and their obviously deposits swell. Obviously, the bank will have higher capital at its disposal to lend, which eventually may actually render the decision makers to take enormous risk at the cost of the depositors' money being put at the gallows. Also understand, the faster the bank progresses, the better the probability that the promoters would recoup their entire equity capital. So if the bank grows fast enough, its business actually expands fast enough, obviously the promoter's equity will be fully recovered in a much shorter time. And that is dangerous, isn't it? Why? Because think of it, if I had invested $100 and because of the improved business scenario, if I have been able to recover my entire 100, then practically my skin in the game has become zero, and yet I have the entire controlling stake in my hand. And at this point, I will do anything, because I've got nothing to lose. I will do anything to ensure that I take home as much profit as I can, because I have nothing to lose. It is with this objective that the regulators understood that the promoters' extended interest may actually drive any banking structure to an enormous risky zone. And ultimately, if not regulated, if not controlled, then it may actually adversely impact the depositors. So as far as the depositors are concerned, they sit on the liability side of the bank's balance sheet. Also, we must understand that the deposits and the depositors' money are always of short-term nature, while the loans that are actually being advanced, they are long-term in nature. So there is a natural duration mismatch between the asset sides of the bank and as well as the liability side of the bank. So this is an additional aspect that the banking promoters will have to take into consideration before they take on businesses unreal. Because of this duration mismatch, there could be a liquidity crunch at the bank's end, where the depositors may come and ask for their money, and the bank's branch may just not have the cash to discharge its liability. And that is a very, very dangerous thing to happen. And the other thing, as we talked about, that there could be macroeconomic factors, there could be systemic risks, there could be specific risks. For example, one borrower may actually fail. All of these risks may also create something called as structural default. And in such cases, the promoters, should the bank actually go kaput, the promoters really have got nothing to lose. if they have survived long enough and if they have actually recovered their entire capital. Also, do remember that as far as the bank's balance sheet is concerned, the equity, so long as the equity portion is able to sustain the bank's operation, we call the bank as the going concern bank. But if the equity portion of a bank has gone kaput, in that particular point in time, we call the bank as the gone concern bank, because now it's at the mercy of the debt providers and the depositors. Should they not actually withdraw their capital, the bank may still survive for some time. So it is not only in the interest of the bank itself, but also in the interest of the banking industry as well as the depositors, that the regulators keep a close eye and understand and ensure that the equity is well funded. In other words, the equity is well capitalized. But hey, come to think of it, when you started a business, all that you had to put in was $10,000. You expect the business to grow so that this $10,000 may someday become 1 million. But because of this inherent problem in the banking structure, which we have discussed so far, think of it, if the regulator actually comes breathing down your neck every 5 years or every couple of years or maybe every year and say, well, you know what? Your business is increasing, so why don't you increase this $10,000 of your initial infused capital to maybe $50,000? Now, here comes the problem. Not every promoter will feel comfortable, because then this actually goes against the very principle of the business itself as far as a for-profit organization is concerned. I did not put my money of $10,000 just to be told by a regulator that another 50,000 has to be put back in the capital just because my business has grown, right? So what is the remedy? The remedy could be perhaps that if there is a staggered way by means of which the promoter's stake can be actually diluted to zero, then perhaps things can be said to be in a safer zone. Why? Well, come to think of it, what the bank is actually doing. On this side are the depositors, and this side are the borrowers. The bank does the raises the capital from the depositors and lends it to the borrowers, right? So in other words, it is just acting as a conduit. Any commercial bank at the end of the day is acting just as a conduit, as a pipe, as a channeler, as a channel to fund or funnel the money from the depositors end, that is the capital providers end, to the capital users end. In other words, the bank, any bank for that matter, is by the public and for the public. So why don't we actually remove the entire ownership of the promoter over a given period of time? Because if we do so, then obviously the promoters will no longer be in a controlling situation, and they perhaps will have lesser incentive to subject the company or the bank as such to some risky loan proposition. Of course, as we say all of this, please do understand, history is replete with examples where the promoters of the bank have subjected their banks to unimaginable kind of risks. And it is because of regulation that we have understood, we have come to realize that the absence of regulations, proper regulatory framework is why the perpetrators could do what they did, a white collar crime. So enough, I think I gave you quite a vista of the entire banking industry, how they work, why regulation should be there, why the promoter stake should necessarily be diluted to zero over a period of time, and why the banks should be mindful before making loans and advances to customer, so as to see that the depositors' money are not subject to some unwarranted risk. Okay, so in my considered opinion, these are the three most important aspects of why regulation is important. To curb the promoter's interest and their control, of course, to safeguard the depositor's money, of course, and also to see that the bank is able to retain its solvency margin so that the bank can weather through tough time or stress times. And how does the regulator achieve that? Mandatorily bring all lending entities under the purview of regulation, of course, to dilute the original promoter stake to nil over a period of time, of course, to ensure banks are not only compliant but are also able to maintain their solvency margin in the short and long term. In the bracket, I have used a couple of acronyms. One is called the LCR, another is called the NSFR. LCR stands for liquidity coverage ratio. Liquidity coverage ratio. And NSFR stands for net stable funding ratio. Of course, the regulator has a few more arsenal up its sleeve, a few more tests up its sleeve to understand the health of the bank. But these two are few of the primary measures, the LCR and NSFR. Now, in a nutshell, what should be an LCR? Well, people who have a little bit of an understanding of little bit of accounting understanding would have come across a term called as CR, or current ratio, right? The definition of current ratio is current asset divided by current liability. And we want this score always to be greater than 1, no less than 1, of course, right? Why? Because we wanted to see that in the short run, in the near future, the company's assets, the liquid assets, are good enough to meet the imminent liabilities. Well, the liquidity coverage ratio is something very similar to this, but is being actually counted over a 30-day period. So that is to say that the regulator wants to see that the bank's assets are good enough, to sustain the bank's liability over the next 30 odd days. And when we talk about liability, we are talking about not only the depositor's money, of course, but also we are talking about the day-to-day banking expenses. Remember, bank has thousands of branches across the country. So each branch will have its own expenses, their salaries, their wages, the electricity bills. So the bank is able to sustain those operations for the next 30 odd days. The measure of that is something called as the liquidity coverage ratio. On the other hand, the net stable funding ratio, if I were to actually give you a very rough idea, is nothing but a bigger version of the liquidity coverage ratio itself. Remember, we talked about the liquidity coverage ratio being for 30 days. Well, the NSFR is for 12 months. So in a nutshell, you would want to see that your assets are good enough on your balance sheet, which are going to actually see you through for the next 1 year. And again, all other things remaining constant, you would want this ratio to be at least greater than 1, no less than 1, of course. Okay, so these are two primary measures that the regulators periodically check for the bank to see the health of the bank itself. So it's like a diagnostic tool as far as the regulator is concerned. Now, we talked about the probable failure of a bank by the structure itself, and how the promoters of a bank can actually, if they are unchecked, can actually subject the bank to enormous risk. So as a mitigant, the regulator insists the promoter to keep certain capital reserve in their organization, in their bank. And the capital requirement, there are certain, itsy bitsy formula in and around the capital requirement, how the capital requirement should be actually calculated. But all said, the capital requirements are so directed that they should be able to sustain the bank such that the banks may just fail once in 1,000 years. Two sorts of losses are being talked about, the expected loss and the unexpected loss. More of it as we move forward. So, as we have discussed, that the regulator's aim is to ensure that the banks remain solvent. Regulator's aim is really not to say that the bank remains protected. In fact, the very idea that they would want the bank to survive is to ensure that the depositors survive, or in other words, the depositors' money is in safe custody. Regulation per se is not quite biased towards any particular bank. They should not be. Their idea of banks' survival and sustenance is just to see that the depositors are not affected adversely. In other words, some unwarranted losses are not being actually passed on to the depositors under no circumstances. Uh, in order to ensure, so there are two sorts of capitals that are being insisted by the regulator. One is called the Tier 1 capital, and the second is the Tier 2 capital. Tier 1 capital exclusively consists of the equity capital, and the Tier 2 capital are basically released in the form of bonds. Now, these bonds are being actually sold in the market. They are being issued in the market with the caveat that they may carry some higher yield, but they must understand that it is not without risk. So that is to say, if we think of bank's balance sheet, let's just redraw the bank's balance sheet once again. On the right-hand side of mine is the asset side, the left-hand side is the liability and the equity side. So as far as the regulator is concerned, regulator would want the equity to be well capitalized. Well capitalized against what? Well, we discussed all of that. The primary risk of that is the risk of default. There could be other risk, for example, risk of liquidity, some typical market risks, operational risks, etc. Now, the regulator would want to see that the banks is well capitalized to weather any sort of potential loss that may arise because of these sources of risks. Sometimes the equity capital may be insufficient, and in such cases, the regulation allow the bank to raise additional risky capital, which they term as the Tier 2 capital. So these are nothing but basically the bonds that the bank issue in the market with the understanding that should there be a run on the bank, obviously as the line of first defense will be the equity capital provider, but at the line of the second defense would be this Tier 2 capital provider. So the equity capital provider, the Tier 1, the bond capital provider, the Tier 2, so that the depositors who also fall under the liability portion of the banks, they are protected. Their money is protected. So the first hit is going to be taken by the equity holder. The second hit is going to be taken by the bond holder. Now, in order to do so, ultimately, the regulator insists for something called as the minimum capital, or the MCR, minimum capital requirement. Over a period of time, once these regulations were brought in, some of the banks negotiated and lobbied hard with the supervisory bank, that is the central bank of the country, as well as some core committee like that of Basel, that banks, large ones, banks, sophisticated ones, banks that do have the technological prowess, they be allowed to decide upon the course of how much capital they need to keep aside in order to meet those potential losses that may actually come, that may actually manifest. So, on one hand, we had the regulation-driven minimum capital requirement. Let's call that SMC, that is standardized model capital. On the other hand, banks, not all banks, but the big banks who had the capabilities to prove that they are in the better position to actually adjudicate or actually think of, chalk out what their actual capital should be. So they were allowed to draft their own economic capital. Remember, economic capital is always internal to the bank. So we call this internal model-based approach to capital requirement. So under this framework, certain banks, not all banks, maybe the tier 1 banks, they were allowed to decide that how much capital they need to keep aside that they feel is adequate in order to weather through any sort of potential losses. We will see in the subsequent slides the adverse effect or the failure of the internal model-based capital. Before we move further, one more aspect that we need to understand that in today's world, most of the banks are well integrated globally. So that is to say that either through a direct presence of their own branches or through their peer networks or through any other banking partnership transactions, a bank that is based out of India might well have a business exposure in South Africa or in the UK, indirectly, maybe. Some of the banks, obviously, they have their branches offshore as well. Most of the banks, they do have. In other words, banking operations today is pretty much globally integrated. The point being that this is again one more reason that why regulation and uniform capital requirement becomes that much more important. And with this understanding, in 1974, the G20 nation in Basel, Switzerland, first came out with the Banking for International Settlement and Banking Committee for Basel Committee for Banking Supervision. These two bodies came into being, and they formed something called as the Basel Committee. So the first Basel Committee was formed in 1974, but it took almost another decade and a half before the first Basel I regulations were rolled out. And what did they propose? They proposed that the banks, of course, those days, banks were not that much globally integrated as they are today. And the primary risks that the G20 nation envisaged for the banks were that of something called as the credit risk. So their idea was that since they understood that the credit risk is the main culprit that may actually hurt the bank's bottom line, so they necessitated that all the banks should reserve an X percentage of their net income every year and commit this X percentage to their equity capital every year, that should be kept aside, reserved to meet any sort of exigency. As a ballpark figure, an 8% equity capital were earmarked every year to ensure that any sort of credit risk, any sort of default emanating out of credit risk be met through this reserve capital. However, by the turn of the century itself, the Basel Committee recognized that the banks not only face the credit risk, but as we have discussed before, they also face something called as the market risk. 1999, the year following that, the Basel II revision came into being, and the capital charge requirement for credit risk were revised. And by 2007, all three risks were classified, they were recognized, and the banks were told that their safety measures, their required capital that they need to actually keep on their balance sheet as a whole, should not only transgress the credit risk of the bank separately identified, but also the market risk as well as the operational risk, all three separately identified. We are right now in the midst of Basel 2.5. Basel 3 has in fact been launched in 2018. The full convergence is expected somewhere around 2027, by which time all of these risks will integrate, and obviously there is a new requirement of capital that is being actually talked about. Nonetheless, so our understanding of why reserve capital is required is perhaps well placed now. Okay, so from here we move to the next aspect of the banks, and that is something called as the deposit insurance. And deposit, more precisely, deposit insurance and moral hazards. To boost the banking sector, because it forms the part and parcels of the credit market, it is essential that the depositors' confidence be instilled and enhanced. In order to do so, most of the developed economies have a mechanism by means of which they insist that each of the banks must partake into something called as deposit insurance by paying a small premium. This deposit insurance ensures that should there be a run on the bank, should there be an exigency, because of which the depositors may potentially face some threat of usurping their capital, their savings, or losing their saving, they be fully protected. The intent was absolutely right. The act and the implementation of the same were equally laudatory. However, the perception of the same was something not quite intended. This led the banks, the commercial banks, to assume more risk. Why? Well, it is something similar to that they knew that their back is now covered, their actions are now being covered. Should there be any wrongdoing, should there be any adversary, any default, any sort of market volatility, that may impair the bank's ability to generate profit. In fact, it may render banking operations in losses. The flames should not actually reach the depositors. The central bank of the sovereign takes guarantee of that. Now, once that belief is well cemented, that led the banks actually to assume more risk. This is something we call as moral hazard. So in other words, moral hazard is when the insured, in this case, because we are talking about insurance, so the bank here is the insured party. So the moral hazard is something where the insured knowingly, purposefully perhaps, assumes risks or indulgence in practices which it should not, or he or she should not, knowing the fact that their actions are being covered by the means of insurance. So take, for example, if somebody buys in, let's say, health insurance, and he keeps on smoking with the understanding that, well, what difference does it make? I have my insurance, that I have my cover. Should anything unfortunate happen to me, there is an insurance company that is going to take care of my medical expenses. This gives rise to a carefree lifestyle where the smoker may actually indulge into further smoking, maybe a little bit more than what he is habituated to. This is what is called as moral hazard. Moral hazard is a practical problem in any insurance business. From there, we now actually move into something called as the trading book versus banking. Now, a bank is also an organization, and as an organization, it reserves the right to enter into practices, enter into trading and investment practices. The bank's proprietary desk is that trading desk that takes care of the bank's own money, and do mind the word, I'm stressing and emphasizing on bank's own money. So that is to say that's bank's own book values, bank's own cash, bank's own equity. So the trading book or the trading desk are those desks that are tasked to carry out bank's treasury operations. On the other hand, The banking books are basically those books which consists of lendable assets and depository liabilities that are expected to be held till maturity. Now, why are we discussing these two? Again, the same aspect, because if you look at the banking book and if you look at the trading book of a bank, these two predominantly are to be separately identified. Why? Because at the end of the day, we are talking about capital and we are talking about loss of capital. This capital loss is going to directly affect our depositors. Money is completely fungible in nature. So that means that whose money is actually on the line as far as the trading book is concerned, because from the trading book, whatever profit that actually generates is going to accrue to the bank. But in the similar aspect, whatever loss is being generated, that must also accrue to the bank itself. However, if it is not separately identified, the banks may actually play around and identify that portion of the money where it feels convenient in the banking book and that portion of the money which it feels convenient to its purpose in the trading book. So they would predominantly do this in order to reduce the requirement of the capital. So that is the reason that why the trading book and the banking books, they are supposed to be separately identified. Here we have depicted the different types of capital requirement for the banks. For example, banks have to maintain capital to cover potential expected and unexpected losses arising from its various activities, including credit, market, and operational risk. Apart from the regulatory requirements, banks also calculate something called as economic capital. But do remember that this leeway were only being provided up until 2007-2008 to some of the biggest banks. Post the 2007-8 crisis, it became very much evident that the free will that was being provided to some of the sophisticated, so-called sophisticated and improved banks actually failed to address the core issues of capital requirement itself. Because when the crisis came, all of those models actually failed. So from here, we move to the investment banks. Now, what is an investment bank? We already have discussed that they are of two sides. One is a sell side advisory and another is a buy side advisory. And they do anything but the commercial bank activities. So to that extent, obviously the investment bank is a misnomer. We talked about it. Let's now read out through this passage and understand a few of the definitions. The 1933 Glass-Steagall Act clearly delineated between the functionaries of the commercial bank and the investment bank and demarcated the lines, the no-go zone. Why there should be a no-go zone? Because a few of the for-profit people should not be allowed to gamble with public money. And that is why we need a clear distinction and separation between the commercial bank and that of an investment bank. Of course, by the turn of the century, the unbridled and the insatiable use of the derivatives products blurred the line between the investment bank and commercial bank. So much so that by 1999, a 66-year-old law was repealed completely. And then the floodgates were open. And the fallout of that, the nemesis of that, was something that was largely witnessed in the 2007-2008 subprime financial crisis that actually subject the entire world to an economic abyss. Come 2008-2009, that is a year after the crisis unfolded, the Dodd-Frank Act at the behest of Paul Volcker, the ex-chairman of the Fed Reserve, came into being. And the Dodd-Frank Act was nothing more than, of course, it did build on the earlier Glass-Steagall Act only. So, which is to say that the Dodd-Frank Act exactly repeated the same thing as that of the Glass-Steagall Act. So, to begin with, they say that these two banks should always be kept separate. There should be something called as Chinese wall. A commercial bank should not be given the license to operate as an investment bank and vice versa. However, we must also understand that because of the very strong lobbying, there was a significant change also that was being brought in. And that was the creation of something called as BHC. What is a BHC? Well, the BHC stands for Bank Holding Company. The bank holding company, a bank holding company can have two banks running in parallel and doing two separate business. Isn't it funny? I think it is. In order to ensure that there is no transgression as such, so they did talk about Chinese wall, they talk about periodic audit and so on and so forth, but it's again not without risk. The question is that what does an investment bank really do? So few of the activities we talked about investment banks already. Now let's talk about few more. As I said, if you think of this, these are mostly the sell side advisory of an investment bank. Okay. First, they help through the placements. Placements, private placements, public issues. They also advise for joint ventures, mergers, acquisition, corporate banking, corporate restructuring, and stuff like that. Okay. Now here, I would like to take a small detour. Do the commercial banks also do these things? Well, the commercial banks are only allowed to sell government securities. Number one. So if you have a GSEC, if you have a TSEC, a commercial bank is allowed to sell, market those issues. A commercial bank, in addition, is also allowed to do business in some private placement. That's also allowed. However, a commercial bank is not allowed to carry on this particular activity. This is a predominant prerogative, arena, precinct of the investment banks. Now, let's see how an investment bank works. Let's say we talk about company X. This company is supposed to go to public, right? So going to public is through the initial public offer. So here, the investment banks may work this IPO through either something called as the best effort basis or a firm commitment basis. As a best effort basis, the investment bank would charge perhaps a flat fee. An investment bank also charges a flat fee in private placements as well. But in case of an IPO, the investment bank may actually charge a flat fee, or it can actually go in something called as a firm commitment. Where lies the difference? Well, to speak in a nutshell, let's say we're talking about a 100 million public issue of X company. Now, this issue may succeed or it may fail. What do we mean by that? Well, this may be subscribed fully or this may be undersubscribed. Either of these two things can happen. However, the point to be noted here is that under the best effort basis, should the investment bank actually broker this particular deal, they would be charging a flat fee. What do we mean by that? Well, they might say that, I'm going to charge $2 million come hell or high water. That means I could care less whether your issue is fully subscribed, oversubscribed, or undersubscribed. I would not be party to that. Whatever happens, the good is yours, so is the bad, but I'm going to put my best foot forward, and I would want a flat fee against the services that I provide. So that's a flat fee. That's a best effort basis commitment. That's a best effort basis services that the investment bank may actually provide. Then the merchant bank, on the other hand, may also come in with a firm commitment basis. What is firm commitment? Well, let's again talk about the same IPO that the company X wants to raise $100 million. And let's say that it has signed an exclusive mandate with the investment bank A or a merchant bank A. This merchant bank A understands that the potential of this issue is much bigger than what the company is actually asking about. So it thinks that maybe it's just possible that they would be able to buy this issue privately from this company and then remarket this issue in the public. So in other words, the IPO that this company was about to launch directly, in this particular case, there is a two-step approach to the whole process. The first being that the X will sell its entire stake to A, and step number two being A is going to take this issue now public. Of course, A understands the potential, and hence A believes that they could actually make a lot more than this 100 million. So in this case, A may offer X 100 million and then suitably price this issue in such a position that perhaps that they are going to make public this issue at 150 million, thereby making a clean sweep of $50 million. This is called a firm commitment basis. But do remember that in the first place, the investment bank has really speaking no risk at all, because it does not participate in the profit or the proceeds of the IPO. It does not participate in the loss either. But in the second case, the entire risk is being borne by the investment banker itself, by the merchant banker itself. Why? Because company X's aim objective was to raise this 100 billion. It could come via the route of the IPO, where the investment bank would have brokered the deal on a best effort basis, or it could be privately sold to that investment bank. The investment bank in turn may actually take up this issue public at a much premium price. So both arrangements do exist. Okay, so moving on to the next aspect of the investment bank and the bank holding company, there are a few things that we need to keep in mind as far as the conflict of interest is concerned. Remember that a bank holding company is the one that actually operates the commercial bank company as well as the investment bank, right? They do profess that there is going to be a Chinese wall. There is going to be a Chinese wall, which is going to separate the activities of the commercial bank from that of the investment bank. And obviously, they are going to ensure that there is no information transgression. There is no passing of information, sensitive one, mostly, from one entity to another. That may actually compromise the privacy or the or profit or well-being of the customer of either of this entity. Nevertheless, from time to time, there are certain conflicts that are being observed, especially if there is a banking holding company. So the first thing is forced placement in discretionary account. Let's take an example. And the example is that we are talking about a company XYZ. XYZ wants to take out a new IPO. Okay. XYZ has given a mandate to company ABC. Company ABC is a merchant bank. Now, ABC also has a brokerage unit. And this brokerage unit has some discretionary client account. What do we mean by discretionary client? Well, it means that the brokerage has full discretion on these clients' account, how they want to place the securities, which stocks to buy, which stocks to sell, which bonds to take position into, how much, and for how long. So this entire portfolio management is at the disposal of the brokerage firms. That's what we call as a discretionary accounts. Now, it's possible that this particular company is of a mediocre nature, and they're not very sure that how the market is going to respond to their IPO. Maybe the response is going to be lukewarm in nature. But in order to actually garner and boost the IPO from the very beginning itself, to give them the requisite fillip, the ABC, that is the merchant bank, may actually try to influence the broker to buy in the few primary shares, the initial shares in their discretionary account of the client. If this kind of lobbying and influencing is strong enough, then it is possible that lemons are actually being passed on. So who is going to suffer? Obviously, the investors are going to suffer out here if they have got a bad company in their portfolio via this IPO. So that is what is called as the forced placement in discretionary account. This is a pure conflict. The second is securing confidential information. Okay, so let's take one more example. Let's say XYZ wants to acquire a company, MNC, MNY. Okay, so this is the target company and this is the acquiring company. XYZ appoints ABC as its negotiator, middleman, investment bank, broker, merchant bank, whatever you want to call it. Basically, the one who is going to do this matchmaking activity, who is going to draft the whole deal, who is going to make this JV happen or this acquisition happen. MNY has a bank, works with a bank called LJ. ABC and LJ are both covered by a bank holding company, which means LJ is owned by the same entity that owns ABC. In such a situation, ABC might actually disgracefully, sportively acquire some sensitive information about MNY from LJ, thereby breaching the privacy. And thus, such sensitive information may be unwittingly and unceremoniously being passed on, to the acquirer in advance, thereby putting the acquirer in a much better position as far as informed decision making is concerned. So remember, the acquirer XYZ may use those pieces of information to its advantage while negotiating the deal with MNY. So that is what is called as the securing confidential information, especially in an acquisition bid. The third conflict is issuing favorable rating to win business. Well, this is all too very common. So let's again talk about a company called as JKL. Now, this JKL company has some agenda, has a certain acquisition plan, has certain business expansion plan. And then there is this merchant banker called UVO. UVO wants to win business from JKL, but it's not been able to make quite the inroads that it was actually hoping for. UVO also has a research report writing division. Okay? That's because we discussed this is what the sell side advisory does. UVO influences their research department to issue some favorable report about JKL. Just in order to please JKL, if such reports are being made public, it may be again be passing on potentially some lemons to unsuspecting investors. So here, the conflict being that they are misusing their research report writing division in order to win business from JKL. The last conflict that is being discussed is redrafting a distressed loan to a public bond. This also does happen. How it happens? Well, you can think of a company, let's say the company being 1, 2, 3. 123 banks with BB. BB is the bank for 123. BB's counterpart under a common BHC is XZI. Remember, this is the investment bank and this is the commercial bank. Okay, and they both are somewhere connected through a common BHC, bank holding company. Now, let's imagine a situation that 123 company has taken out a loan from BB and now it's in a financial distress. It being under a financial distress, terrible distress that it is in, it is finding very hard to actually repay that loan. XZI comes to the rescue and it exerts some undue influence on BB, proclaiming that this, if we do not find a way to actually save 123, then perhaps the loan that you have made to 123 may go very bad very soon. XZI may actually start writing some reports. XZI may also start to raise some capital. That is to say, they may actually try to float a new NFO, a bond, that is, in the public. They would be doing that. If they do so, and investors actually are gullible enough to actually purchase this bond, effectively what has happened is XZI, that is the investment bank, has actually transformed a private debt into a public debt. Thus, saved its counterpart, that is the BB bank, and perhaps saved them as well. Because if they do default in that public debt, not much can happen perhaps. Obviously, it depends upon the bond prospectus, but I'm just making the point out here. So redrafting a distressed loan in such a manner that you convert that private debt into a public debt, that's obviously a very, very serious conflict of interest. And as I said before, that a few measures are and can be taken, but not all of them can be mitigated to the full extent. For example, creation of Chinese wall could be one of the answers, conducting periodic audit to ensure that there is no leakage of information, there is no transgression of information from the investment banking division to the commercial banking division or vice versa. I have particularly and deliberately used the word BHC. This may not actually feature in your curriculum per se, but most of these problems are actually found telltale when you have a common bank holding company. Thanks to the redrafted and revamped Dodd-Frank Act, which allowed the bank holding company to come in the first place itself, where a bank holding company may have a commercial banking division as well as an investment banking division, albeit separated by some sort of glass door. Okay, so after having done so much of our theory, let's get into a few of the mathematics out here. So the first problem that we are going to address is that of Stylist Confectionery. So let's read out the problem. Stylist Confectionery intends to go public with the first IPO with a size of 1 million shares in a price band of $120 to $140 a share. Angle is the merchant bank here, so that is the IB here, is mandated to take the issue public. Angle is mulling the idea of taking the offer on either a fees only, that is the best effort, or a firm commitment basis. Angle would charge $10 million if it were on the best effort basis. Now let's boil down to the scenarios. Stylist wraps up the IPO and the listing price was 145 as the issue was slightly oversubscribed. Mind you, what is being said, the IPO still closed at the price band of 120 to 140, but it got listed at 145 because the issue was slightly oversubscribed. what is the pre-tax profit of Stylus that makes out of the offer? Okay. So the answer to this is that this is an indeterminate question. Why? Because we do not know for a couple of reasons. One is when a company raises an IPO, it does not make mention that it is making a profit by selling its share. No, that is not the case. Only one of the three things or a combination of the three things is correct as far as an IPO is concerned. The first being either retirement of debt, exit of key shareholders, mostly what is known as the offer for sale, or third is expansion of business. In none of them, the IPO ever mentions that there is a profit motive out in the open as far as this IPO is concerned. Of course, we must remember that every company will have its book value at an IPO. The price at which the NAV would be, the net asset value or the book value would be, and the price at which it actually floats the IPO at, the issue price. The difference between the two, of course, may count for some sort of profit, some sort of gain, of course, that may account for if the IPO were to fully subscribe, but that's not the terminology that is being used. Okay, so A, we do not know what is the book value or the NAV of Stylus out here, and B, we do not know for what purpose this IPO has been floated in the first place. So in absence of these two, even though the issue price is the listing price has been 145, please do remember this listing price do not accrue to Stylus here, because Stylus has sold this issue in the price band of $120 to $140. The best that could happen to Stylus is if the issue is really oversubscribed, the issue might have been sold at a higher end of the price bracket itself. Mostly if the issues are undersubscribed, in those cases, the issue might be sold at the lower end of the price bracket. Here, since they have said that the issue is slightly oversubscribed, so in all fairness, it is correct to assume that the issue was actually subscribed at the higher end of the price bracket, that is $140. But still, all say, since we do not know what has been the book value and we do not know for what purpose this IPO was floated in the first place, we cannot say, and that is absolutely an incorrect statement to make, that Stylus is going to make some pre-tax profit out of this. There is no pre-tax profit out of this whole thing. Second, Stylus issue was undersubscribed and the listing price was at a discount of 15%. What is the pre-tax profit or loss of Stylus? Does Angle lose or win in either of the scenarios? Okay. First of all, if Angle, the merchant banker, has taken this issue on a best effort basis, that means it should only be content with the 10 million fees that it is collecting. It could care less, honestly speaking, whether the issue is fully subscribed, it is oversubscribed, or it is undersubscribed. It would still walk away with its fees of $10 million intact. So in either of this scenario, does Angle lose or win? Well, Angle makes its money. There's no question of losing anything. Angle makes its money because its involvement, engagement in this whole process is limited to up to its extending services. That is on a best effort basis. And again, if it is undersubscribed, does Stylus make any loss? No. Stylus, again, for the same reason as has been explained and depicted earlier, there is no question of profit or loss out here, gain or loss out here. This discount of price of 15% is to be borne by the investors who had subscribed to the issue and not the Stylus. If the issue is undersubscribed, as we have explained before, the possibility that the issue might have gone at 120 instead of 140. That could have been the case. Let's look at the next problem. It is a repetition of this same problem. With the twist being, it is now going on a firm commitment basis. Since it is going on a firm commitment basis, the offer price of Angle to Styrus is $110. Okay. Now let's say what happens. Scenario number 1 says that Styrus wraps up the IPO and the listing price is 145. What is the pre-tax profit for Angle Merchant Bank out here? Now, here again, we need to understand that we cannot say what exactly has been the profit as far as Angle is concerned. Why? For two reasons. Reason number one, we know at what price Angle has bought the shares from Stylus. Stylus wanted to raise capital and they were trying to price this issue between 120 to 140. Angle negotiated and offered them 110. Right? So to this extent, if Stylus has actually agreed to sell their entire lot to Angle at 110, then Stylus is off the hook as far as this IPO is concerned. It could not care less whether Angle and how Angle takes this issue to the public. Because as far as Stylus is concerned, they have made their bucks out here, and then it's up to Angle that how Angle proceeds with that. Now let's just imagine a scenario that Angle does actually price the issue at 140 itself. Remember, it's not mentioned exclusively at what price Angle has floated the IPO. But if we do assume, just to be the devil's advocate, if we do assume that Angle priced this IPO at 140 and the issue is at 145, that means after subscription on the listing date, on the opening date, the issue is at 145. That means it is slightly over the higher price bracket of the IPO itself, right? So in this case, Angle would make, if we assume that this has been the case, in this case, Angle would make a clean sweep of $30 a share, and that is its profit. Scenario number 2. If it is undersubscribed and the listing price was at discount of 30%, what is the pre-tax profit or loss of Angle? Does Stylus lose or win in either of this scenario? So let's first answer this question first. Does Stylus lose or win in either of this scenario? Well, Stylus does not lose anything. Why? Because it has already sold its entire proceeds under the firm commitment to Angle at $110 a share. How Angle markets it? Who subscribes to that? Whether that subscription is under subscription, full subscription, over subscription, Stylus could care less about that. Stylus does not suffer any loss out here. The next thing is that if it is undersubscribed, then it is quite possible that Angle may not have been able to sell the issue at the price that it intended. But again, because those data are not being provided, we cannot make a full evaluation of Angle's loss out here. From here, let's take the next problem. And this is that of the Dutch auction. I reckon that this kind of problem may actually appear in your actual exam itself. Okay. Let's see what's being told. Angle Merchant is promoting Webster Astra Publishing Housing. Because of the size of the issue, Angle believes it is better to go in for private placements. Webster hopes to mop up $100 million and are ready to offer 500,000 shares. So almost 500,000 shares. Angle believes it can successfully market the issue without much hassle. Accordingly, Angle invites closed bid participation from private bidders. The top 10 bidders came up with the following offer. Okay, so let's rehash the problem once again. We're talking about a company, Webster Astra. It wants to raise 100 billion. 100 million is not that much of an amount. Their merchant bank, Angle, believes that they could easily sell this entire proceeds and at a much faster pace to private bidders as well. because the entire proceeds is only for about 500,000 shares, which is also not much. So Angle believes that it may be in the best interest of both the bidder as well as Webster Astra to going for private placements. Angle arranges for that private placements. So in order to do that, Angle invites a closed bid participation. That is to say, a participation by invitation only from private bidders, and then ranks those bidders as per the top 10 price quotation. So let's see which are those top 10 are. In no particular order, we have A, who has quoted for 100,000 shares at a price band of 250, followed by B, written here, at 65,000 shares at the price band of 350. Then we have $150,000 shares. 150,000 shares. This is 100,000 shares. Yeah, this is 150,000 shares quoted by C, and then 55,000 shares quoted by D, so on and so forth. Now, here we are supposed to distribute the shares in a Dutch auction manner. So how the Dutch auction works? So the way Dutch auction works is that first, if we have this unsorted data in front of us, we sort this data and sort this data from an highest bid to lowest bid. In other words, in a descending manner. Okay. So in this descending manner, if we were to actually arrange this bid, so we would see the highest price that has been quoted is by G, 325. So this is, I say, price quote number 1. Quote number 1. The next in line, sorry, I'm so sorry. Quote number 1 is B, that is 1, because it has quoted 350, followed by G at 325, followed by G at 325. This is the second highest bid, followed by J and E, both at 280, followed by A at 250, followed by D at 240, followed by I at 225, followed by H and 190, and then we have C at 175, and last being F and 155. Now, in case of Dutch auction, the one who has quoted the highest will get its entire share of application. So if I were to decipher this, the highest quote has that been of B. So that means B gets 65, all are in 1,000, 65,000 shares. We also create the cumulative shares out here. So we have 65,000 shares all in 1,000 once again. Then the next in line is G. So G has quoted for 80,000 shares So G gets 80,000 shares. So here, if we accumulate, this becomes 145, right? Now followed by E, who has quoted again 80,000 shares. So we add 80 to this. This becomes 225. Followed by again one more, that is J, that is quoted 280 for 125,000 shares. So if we add 125 out here, we will get 350 cumulatively. Okay. After this, is at A. A gets 100,000, so that becomes 450. And then we have D. D has quoted for 55,000 share. So here, if we add 55, now this becomes 505,000. Now here, there is a problem. The problem is that cumulatively, if we add, it should add up to only 500,000 shares. That means beyond 500,000 shares, there is no way the subsequent bidders may get their share. So D, in fact, even though it has quoted 55, but because of this hierarchy, it is only going to get 50,000 shares. Okay, obviously, the ones who have quoted below D, they will not be entertained at all, which is to say that they are not going to get anything out of their share that they have quoted for. Okay, so we can easily see that I, H, C, and F, they are not going to get anything. This is what a plain vanilla Dutch auction looks like. So from here, we can see how many shares do the bidder I, D, J, and A receive. So we can answer this question. I receives 0. D receives 50 only, 50,000. Though it has quoted for 55,000, it receives 50,000 only. J receives full 125,000 shares it has quoted for, and A also receives full 100,000 shares that it has quoted for. Is the issue fully subscribed and investor raises the expected dividend? The answer is yes. It raises the whole capital as it has asked for, and the issue is fully subscribed. All right. Few of the poison investment banking poison pills and conflicts of interest. So we already have talked about the conflicts of interest in the previous slides, that how conflicts of interest can come into picture and how they are being handled. Here now we're going to talk about some of the other conflicts and the handling of that. Now, mergers and acquisition. What kind of deal there can be? So in case of mergers and acquisition, let's say we have a company A and company B. If we talk about acquisition, please understand the word mergers and acquisition, even though they are used in conjunction, they're quite different. Let's first talk about the acquisition. If A were to acquire B, that is to say A is the acquirer, B is the target, then A could make an all-cash offer to B. A could also make an offer wherein it will pay partly in cash and partly it will pay in stock. So in other words, they would perhaps swap certain shares between themselves apart from the cash. This is one way the acquisition can be effected. Similarly, following the same line, if we're talking about mergers, Mergers mostly happen through share swap. In mergers, there is no involvement of cash as such, but simply share swap is what happens in case of a merger. Yes, the ratio of share swap is a subject of debate. It could be a ratio of 1:1. It could be a ratio of 2:1, 3:1, so on and so forth. It all depends upon how good the negotiation goes and who is on this, who takes the upper hand in such negotiation. Now let's imagine a scenario where there is a target company in the market, and then there is a aggressive acquirer. So this acquirer, predatory, I must say, wants to take control of this company. In other words, it wants to buy this company come hell or high water. But the target company does not want to actually get acquired. It does not want to sell its stake. It does not want to lose its identity. It does not want to be acquired by it. In such cases, in corporate world, these things are common. In such cases, are there any suitable defense that the target may actually erect in front of the acquirer so that the acquirer is dissuaded? The investment bankers come into picture here as well. They could advise their clients. Here I'm talking about the target company, wherein the target company may adopt certain measures by means of which it can evade the possibility of hostile takeover. Now we're going to discuss a few of them here. So the first thing is issuance of preference share, those preference share that will be subject to convertibility. And here, when we're talking about convertibility, we're talking about compulsory convertibility to equity shares. So that is to say that the target at one point in time may have issued some preference share with the caveat that at any given point in time in the future, if the company is a subject of a hostile takeover, then those preference share will be immediately considered to be converted to common equity shares. You might argue that what is the great purpose of this? Well, for one, it increases the number of shares, right? Since it increases the number of shares, the per share value obviously is going to come down because the entire book value of equity sits on the numerator. But because of this dilution, because of the compulsory convertibility of the preference share into common share, the number of shares in the denominator increases. And because it increases, so that is why the per share value is going to come down. And then the acquirer post-acquisition, that issue or that deal may not look that lucrative, may not look that good as it was before takeover. So that's one way to thwart the effort. The second would be to restrict the voting rights. Yes, an investment banker may also give certain corporate management, certain corporate advisory of this nature, wherein the number of votes will not be tied with the number of shares that somebody owns. So for example, if there are 100 shares and I own, let's say, 51 shares of this company, there could be a scenario wherein just because I have 51 share of the company and I enjoy the absolute majority, that may not automatically put me in the pedestal where I also enjoy the 51% of the voting rights. Now, such an arrangement must be mentioned beforehand in the charter or the articles of association or the memorandum of understanding of the company inception days itself, which is called as the restricted voting rights. Encashment or exercising ESOPs that result in dilution, yes. The ESOPs or the employee stock options, the warrants, these are dilutive instruments. So a deal could be such struck, a voting mechanism could, a deal could be such struck, or an arrangement can be such made that if the company faces any sort of takeover threat, the ESOPs will be immediately be exercised or deemed to be exercised, basically to ensure that the number of share increases. And as before, if the number of shares does increase, that would only dilute the overall per share value because of the higher denominator, while the numerator remains constant. Assuming large corporate debt, yes, that could also be one mechanism, because if the target is now completely cocksure that the acquirer is not going to leave the opportunity to rest on its laurels, it will relentlessly pursue the acquisition of the target. The target may acquire a large corporate debt, thereby burdening the acquirer post-acquisition. Last would be impossible cessation of key resources. A recent example of the takeover of Twitter by Elon Musk is one of the prime examples that I could think of, where cessation of some of the resources were completely made impossible for some period of time after the takeover of Twitter. Now, these are a few of the efforts that the investment banks may actually advise their client being the target company, which is a subject of acquisition. These measures, these 5 measures that we talked about, collectively are called poison pills. The poison pills are, in a nutshell, are effort to dissuade a otherwise hostile acquirer. Poison pills in some countries are banned. They are deemed illegal, but in most of the developed economies, they are considered a necessity. Okay, so coming to the last portion of this chapter, we have 3 questions which I have directly picked up from the guard book, and I want to discuss them. The first thing is, what is the difference between the bank's trading book and the bank's banking book? Why this distinction between the trading too important from a regulatory perspective? Well, the trading book are the ones where the banks will have to designate the assets and the liabilities or derivatives position as short-term in nature. And these are those assets, liabilities, or derivatives position that the banks will have to designate as suffering or are subject to only market risk. Whereas anything other than that will fall into the banking book. The banking books obviously comprises of the loans and advances. Now, these loans and advances, first to begin with, are not tradable. They are not tradable. B, they are to be held till maturity, or if there be an early defacement or there be a prepayment on part of the borrowers. So only in those cases the duration may be shortened. And the third is, the only risk that these loans and advances are being faced by from the bank's angle is that of a credit risk. So banks are supposed to segregate their assets and liabilities in this manner. And that is how bank's trading book is separate and separately identified, different than that of the bank's banking book. The reason that why these separation or distinction is important is because the regulatory capital will differ as far as the trading book is concerned vis-a-vis that of a banking book. As we have understood that these two books are subject to 2 different kind of risks altogether, and the impact could also be much varied. Okay. Next question, explain the risks in funding long-term needs with short-term instruments. What steps have been taken to reduce these risks in Basel III? Well, think of it. Banks' assets and banks' liability. Banks' liability are the depositors, and banks' assets are the loan and the advances that the bank makes. Banks' loans and advances are typically long-term in nature, whereas banks' liabilities are typically short-term in nature. So that means that the debts from one period to another period will have to be systematically rolled over. If the bank is unable, for some reason or the other, because of the bank's own problem, internal problem, or because of the bank or the market scenario, if the bank is unable to roll this debt forward, in that case, the bank will be unable to fund their long-term assets. Now, understanding this being a practical problem, Basel III has asked for enhanced equity as part of the reserve capital or the minimum capital requirement. And obviously, they have also defined certain quality of those equity as well. Question number 3, an investment bank has asked to underwrite 20 million shares. Share price is, so number of shares is 20 million. The share price is currently at USD 24 a piece, and the bank is trying to decide between a firm commitment at USD 20 per share, of course. These are million of shares, 20 million shares, yes. But versus a best effort basis, where it will charge 40 cents a share sold regardless of price. Discuss the pros and cons of the two alternatives. Well, so let's first decide. So let's first decide the best effort basis. So in this best effort basis, the bank is going to charge $0.4 for every share that is being sold. So in other words, the bank is going to get 20 into 0.4, 20 million shares into 0.4, which translates into $8 million of revenue. Now, this revenue is a hard cash revenue that this investment bank is going to earn. It could care less that what happens with the IPO, how the issue is subscribed or is not subscribed, where the listing price is. Eventually, it still is going to walk away with $8 million. In other words, it does not participate in the profit or the loss of it. On the other hand, in case of a firm commitment, the bank is going to buy this share at 20, thereby it can expect a spread of at least $4 a share. If the IPO goes through as is being intended, in this case, the bank is going to earn $80 million on this entire process. How? Because it will purchase at 20 and it will sell at 24. So thereby pocketing this $4 per share on 20 million shares, it's going to pocket $18 million, right? So if you compare this 8 million to 80 million, it may seem that this is a much better proposition. But hey, this is where the catch is also, that if the issue, this 80 million is subject to the share being fully or maybe oversubscribed. In case the issue is undersubscribed, there could be a possibility that this investment bank will not be able to sell the shares at 24 apiece. It may also so happen that they might have to sell it way below their own purchase price. So it may have sold at 20, or it may have sold a price which is less than 20. In either of these cases, it runs the risk of actually incurring losses. So these are the pros and cons of this deal. I hope you enjoyed this session and this session was informative to all of you. We have the following chapters coming soon. Thank you so much.